Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And I wanted to take a look at and discuss, frankly, Zillow's forecasting abilities. I don't know if you've seen this recently, but Zillow has been out trying to forecast the next 12 months of home appreciation. We're going to pull up an article featured in Fortune. One of our past guests, Lance Lambert, wrote it. But I want to talk about Zillow first, because you would think a company with all of that data would be, frankly, better at their job. Let's first off not forget that Zillow began a house flipping business, an iBuyer, in the best flipping market ever, and went on to lose something like $600 billion or some big number. 600 billion, 600 million, probably 600 million, but a big number nonetheless. Yes, it had to be 600 million. Anyways, I digress. Again, not good at their job. They were relying on their models, their artificial intelligence, to basically buy low, sell high. That didn't work out so well. Over the last 6 months, Zillow has taken the same strategy to kind of forecast the real estate markets. And if you remember where we started about 6 months ago, Zillow was still forecasting a 15 or 16% appreciation in the next 12 months. That has since been revised lower and lower and yet again lower. Just 3 weeks ago, Zillow was forecasting yet a revised lower number of 7.8% year-on-year appreciation. This was for summer of 2023. Just last week, they once again lowered it, now to 2.4%. I think we have to take a look at and review what Zillow has and their model, because it doesn't seem to be working. Right? Again, they've relied on artificial intelligence. They're trying to take these data sources across individual units and trying to tell a bigger story. So let's pull up the article. Let's talk about it. And you and I discuss the variables that will drive home price appreciation or home price declines next year. So let's pull up the article. So again, the author is Lance Lambert. He was gracious enough to come on our channel about a month ago. Basically, Zillow now is saying 123 housing markets will show price declines from -1 to something more significant, while 780 markets will go higher. Roughly speaking, that's 15% of markets down, 85% of markets up. Another thing that if you're on my channel, you know that we talk about is real or nominal. I want to be very clear that all the discussion in this article are nominal prices, right? Again, what does that mean? Well, if housing goes up 5%, but inflation is 8%, housing actually went down 3% in real terms. So in this article, let's be very clear, we are talking nominal prices, so we don't get confused or twisted. So let's get into the article a little bit. There is an interactive map. Basically, what Zillow is looking at is the most recent data, right? The housing market crash. Obviously, the housing market is slowing down. If you watched my channel, you know we've talked about a 30 to 50% crash in transactions. New home sales down 17% already. Existing home sales down 20% already and getting worse. Mortgage applications are down and getting worse. Again, at least 1/5 of housing activity has fallen off. You are now starting to hear folks talk about a housing recession. If you're on my channel, this is not new to you. We have been talking about a housing recession and, dare I say, ultimately a housing depression. I think if transactions for new home sales go down 30%, which they are now, according to this week's numbers, 29.6%, close enough. Existing home sales are going lower. I think we just had a reading at 4.68, something like that, 4.71, somewhere in there. Again, lower than 6.6 last year. The housing market, if you're paid in the housing market, it's going to feel like a depression, ultimately pulling the economy into a recession. So a lot of people are looking at this information. And as you expect, look at this, folks. Zillow now cut their forecast, not even a month later, from 7.8 to 2.4%. Now let's go back to the top of this article, right? The top of the article said 15% of markets go down, 85% of the markets go up. But if the totality of that raise is only 2.4%, it is fair to say, again, mathematically speaking, that the markets that will decline, Phoenix, Boise, Vegas, they're going to go down double digits, while the other 780 markets that they are saying will rise will go up fractionally. You can't have 85% of the markets go up and 15% of the markets go down and not have a more distorted view unless the down markets are down big. And by down big, we're talking 10% or more. This is what I believe Zillow is calling. And again, I think a lot of this, frankly, is iBuyers. I think there are certainly some Zoom towns, Boise being the classic example that we've talked about for 6 months, that are in real trouble. But I think the markets that are in most trouble from a pricing standpoint are towns that were dominated by iBuyers. Phoenix, Las Vegas. These markets are going to be in some serious trouble. And again, according to Zillow, again, mathematically speaking, it looks like some of the biggest markets will see some of the biggest declines. Now let's step back and you and I talk about what is going on. So I think there's things that Zillow is missing behind the data. And I think it's going to have a big impact on next year. The most important one being the 30-year mortgage rate. I think the real estate market has digested 6% 30-year money. What did we see happen? We saw transactions fall, but we also saw adjustable rate mortgages rise. I think we saw it rise to 10 or 11%. Basically, what home buyers will do, again, the numbers prove it out, is, hey, if the 30-year money's too expensive, I will bet on a 5, a 7, or maybe even a 10-year ARM. I will gamble. I don't like that gamble, but hey, nobody's asking me. The numbers say that adjustable rate mortgages have gone from 2% to 11%. So again, I think if the 30-year mortgage rate kind of bounces plus or minus 6% for next year, the housing market probably surprises to the upside, at least according to Zillow. I'm not talking big. Believe me, I'm not talking big. I am talking probably inflation plus 1%. So again, what does that mean, real versus nominal? Nominally speaking, if inflation is 5%, and I said inflation plus 1, it would mean housing is up 6. If inflation is 3.5 next year, it means housing is up 4.5. So I am not some raging lunatic housing bull. I generally feel that housing will be flat for 3 to 5 years. Flat meaning plus or minus 1% of inflation. However, if interest rates and the Federal Reserve has to go higher, they take the fund rates to 3, to 3.5, to 4, to 4.5 to beat back core inflation, which I think is stickier than the Fed is looking at. We won't see 30-year mortgage rates at 6. We could see 30-year money at 7. That will slow the housing market down more. That could be a problem. There is another option. Perhaps the 30-year mortgage rate plays with 6% here short term. A recession kicks off in full force. Unemployment doubles, and we actually get mortgage rates around 4 or 5%. I think at that rate, we see, frankly, housing transactions pick up. I think the move-up market, if interest rates get to 4%, I think the move-up market starts back up. If the mortgage rates are at 6%, the move-up market is dead. It's just not moving for several years. So while Zillow is looking at transactions and kind of making a prediction based on their big data set and artificial intelligence, I think they are missing the bigger picture. I think next year, 2023, is all about the 30-year mortgage. Will it be at 7 or higher? Will it be at 6? Or will it be at 5 or below? If you can answer that question, I think we can have a conversation about real estate in 2023. So let me know what you think. Let me know what you think about interest rates next year. Let me know if you think I'm missing anything. I'd love to hear it. I think Zillow is a horrible forecaster. I mean, they cut their forecast 66% again, right? Like in 3 weeks. It's pretty bad. So let me know what you think. Take care of yourself. Have a wonderful day. Bye-bye.